This is day 40 of researching a stock a day until I can quit my job. Today we're diving into the PE ratio. This isn't a lesson on the basics, but to help research stocks it's important to dive deeper into what this metric can tell us. You may have heard that the PE ratio of the S&P is higher than usual, but why has it historically been anywhere? Why 20 instead of 10 or 50? Imagine you had a stock with zero growth potential, but it paid you a $4 dividend every year that was guaranteed by the US government. What would the price of that stock be? If you have no idea, then you don't know the bond market well enough, and to be a complete investor, you should take the time to learn how it works. To answer this question, it helps to know that the US 10-year interest rate is around 4%. Without boring you with the math, the price of the stock and the bond should be roughly the same at $100. We'll go into bond maths another time, or maybe never, but the reason this is important is because when you invert the PE ratio, you get the earnings yield. Think about the earnings yield as the implicit interest rate of a stock. Now, there are many nuances, but over the long run, the earnings yield of the S&P and the bond market tend to track each other. If this was a perfect relationship, then as rates rise, you would expect prices to fall. One simplified way of thinking about this is if you could get a 20% risk-free yearly return from US government bonds, would you still take the risk to invest in stocks? When rates rose aggressively in 2022, equities did fall but then surprisingly recovered. Yes, the huge investments around AI definitely helped, but generally when rates rise from central bank actions, you expect higher borrowing costs to lead to less consumption and earnings and a higher required rate of return for stocks. In the 07-08 crash, the economy was running too hot, and the Fed aggressively was raising rates in 2004 to 2006. However, back in those olden times, the amount of variable rate mortgages were significantly higher than they are now, which means that many people saw their mortgage payments go up with interest rates. Nowadays, nearly all mortgages in the US are long-term fixed, which means that the US consumer is overall less sensitive to interest rate fluctuations. Of course, it helps that you can also buy Chipotle on a buy now, pay later scheme, but that's a ticking time bomb, pun intended. This is not financial advice. Always do your own research.